Learning Objective 14-4, understand requirements for management reporting law. The Foreign Corrupt Practices Act of 1977 is very, very important for accountants, and every accountant should know what it is. Part 1 prohibits bribing foreign government officials, but Part 2, it requires all publicly held companies to maintain accurate records and an adequate system of internal control. And previously, before the Foreign Corrupt Practices Act, believe it or not, companies were not required to maintain accurate records and an adequate system of internal control. And it would seem obvious that every company would do this. It would be in their best interest. But it was not actually a law that companies do this until Part 2. The purpose was, of course, to control spending so that you would be able to detect bribery, but it provides a lot more benefits than that. The most important of recent years is Sarbanes-Oxley Act of 2002, and this came about after the Enron fiasco and WorldCom and a few other scandals after that. And there's some very, very important implications in Sarbanes-Oxley for accountants. The goal was to improve the role of corporate governance and also to somewhat restructure the environment of self-regulation in accounting. Before that, public accounting firms were completely self-regulated through the AICPA, and Sarbanes-Oxley redid that to create more external accountability for accounting firms. There are 11 sections to the Sarbanes-Oxley Act, and we're going to go through some of the more important ones. Title 1 is the PCAOB, PCAOB, we call it PCAOB, Public Company Accounting Oversight Board. And this established a brand new oversight board that would regulate accounting firms, mainly public accounting firms, firms that audit publicly traded companies. And PCAOB actually has the ability to create auditing standards for these accounting firms. SEC oversees PCAOB, and it's responsible for appointing its members. And then the board regularly inspects accounting firms' records, their working papers, and so on, and tests them to see if they're following the PCAOB and AICPA standards. So PCAOB has become an important part of the accounting regulatory structure now. Title II oversees auditor independence, and it tightens up what accountants are allowed to do. So auditors may not provide certain services to audit clients, publicly traded audit clients, including information systems design and implementations, appraisals, valuation services, internal audits, human resources, legal expert services, and bookkeeping services, what we used to call consulting. So accounting firms must determine with each client whether they're going to provide audit service or they're going to provide this rich array of consulting services that they provide. And it's very interesting because auditing firms have found that consulting is a lot more profitable than audit, and for some companies they would rather be their consultant than be their auditor. The lead audit partner and the audit review partner. The audit review partner checks the work of the audit before it goes out. Both of them must be rotated every 5 years, and an audit firm let me put it this way. It used to be common practice for people working for big accounting firms to go work for their clients, and specifically on the clients that they served. So if I worked on an audit engagement with a certain company for 10 years, I really know that company very well, and they're looking for a new CFO, and I would be a prime candidate. And it was quite common for someone to just shift gears and go work for the client, and then the auditor keeps doing the audit, my former employer. So this is no longer allowed. You can't have that revolving door. And they have a 1-year rule here in Sarbanes-Oxley, but the public accounting firms have tightened this up very much to where someone working in a public accounting firm cannot go work for a client for as many as 5 years after they leave. I think for partners it may be 5 years or might even be longer. Corporate responsibility, Title III. Audit committees must include some non-management members, or must be composed of non-management members. In other words, it shouldn't be the actual CFO, president, chief executive officers working on the audit committee. It should be people from the outside so they don't have that conflict of interest. And then the auditors need to report directly to the audit committee and not the management, which is a huge change because previously auditors were engaged by the CFO, not by the audit committee. The CEO and CFO must provide a signed statement to accompany each annual and quarterly financial report, certifying that these fairly present in all material respects the issuer's operations and conditions. And this sounds pretty pedestrian, but part of the problem with Enron and some of the other scandals before it was that the CEO and CFO said, well, we just didn't know. I had no idea this was going on. And, well, you signed this form. I said, well, you know, I signed a lot of papers. So what this does, it really holds their feet to the fire and says, look, the CEO and CFO are responsible for what's in this report. And if there's a misstatement in there, then they are responsible for that misstatement. Title IV required enhanced financial disclosures. And financial reports must reflect all the material correcting adjustments, all material off-balance sheet transactions and relationships that have material effect on the issuer's financial statements. One big thing here is a statement of contractual obligations, which is off-balance sheet transactions, and a real focus on off-balance sheet transactions that previously were ignored. And part of this is all material correcting adjustments. I don't know that this was ever the extent to which this was actually implemented. Each annual filing of a stock issuer must contain an internal control report by management that reports on the existence and effectiveness of the company's internal control over financial reporting, and it must include the following statements here. Management is responsible for establishing and maintaining an adequate system, because managers shouldn't say, well, we rely on our auditors. Identification of the framework used to evaluate the internal controls, which is also always a system called COSO. C-O-S-O. A statement as to whether the internal control is effective as of year end, and it should be effective, otherwise you're in trouble. And the disclosure of any material weakness in the internal control system, and that would be a bad thing to have. Title V dealt with analysts. The problem here was that analysts were being pressured to issue positive reports about certain investments. And if they didn't, they could be fired, or the company issuing that they work for could lose a client. So there was a huge problem here because there was the one analyst who said something bad about Enron before it went under got fired. So they wanted to address this problem. And analysts, brokers, and dealers must report the following when they prepare a research report. Any securities held in the company, compensation received from the company, and if the company was a client of the broker-dealer. So this way, when you read a research report, you can analyze for yourself if the person might have a vested interest in one answer or the other. It also gave more money to the SEC for disciplinary and litigation authority, because previously it was argued that the SEC didn't have enough resources to do its job. And a number of reports that were expected to be written. The first is a discussion of the factors leading to consolidation of public accounting firms. When I first interviewed for my job in public accounting, there were 8 big accounting firms. Today there are 4. And there's real concern that 4 public accounting firms is not enough to do the job. Also, the role of credit rating agencies, and a real concern that credit rating agencies are not as reliable as they could be. and whether investment banks and financial advisors assisted public companies in earnings management and obfuscation of financial conditions. And real concern here that companies actually hire consultants to help them fake their financial statements. Title 8, Corporate and Criminal Fraud Accountability. This was huge because up until you could falsify financial statements and it would be really hard for a company to convict you, for the courts to convict you of fraud. You would mostly be liable in civil court. You could be sued and you could lose a lot of money. And one of the biggest issues in Enron, and the most embarrassing issues, was, first of all, right after Enron happened, Arthur Andersen was indicted for fraud and criminally indicted. And Arthur Andersen quickly, the accounting firm went under. That was the 5th accounting firm, and then we had 4. But the government prosecutors had trouble coming up with a case, a criminal case against the chief executives of Enron, because everything they had done was technically legal. Their financial statements were pretty much in accordance with GAAP, and what they had done was they had manipulated and they took advantage of loopholes to present something that was completely different from what the company really was. But they followed the rules exactly. There was a lot of off-balance sheet financing, things like that. And the government had a lot of trouble making the case for them, making the case against them for fraud. And they realized that issuing false financial statements is not securities fraud. And therefore, that was changed. So destroying records, committing securities fraud, failing to report fraud is in itself a criminal act and subject to punishment as close as imprisonment. Believe it or not, a crooked accountant can go to jail and for criminal prosecution. And after Sarbanes-Oxley, it is very clear. There's also whistleblower protection. If an employee assists in investigating a fraud or other criminal conduct, they are protected as a whistleblower. And from what I understand, this provision does not work very well. So be aware that if your company is being investigated for fraud and you help the investigators, you will probably get fired. White-collar crime penalty enhancements. Minimum penalty for mail-and wire fraud, 5 to 10 years. It's a crime to tamper with a record or impede official proceedings. The SEC can prohibit anyone convicted of securities fraud from being an officer or director of any public company. And criminal liability for up to 5 years for corporate officers who fail to certify financial reports or who willfully certify financial statements knowing they do not comply with the act. So if you refuse to sign that letter, or if you sign a letter that your financial statements are reliable and they're not, you could actually go to jail for 5 years. Congress expressed the expression that CEOs should sign the corporation's federal income tax return. Title 11, increase the penalties for using deceptive devices, engaging in fraudulent transactions, otherwise acting to impede an official proceeding. Up to $25 million and 20 years in prison. And this changes the landscape for public fraud, because previously there were all sorts of defenses to this, and really the worst that could happen is you could get fired and be sued for millions and millions of dollars, more money than you have, and pretty much end your career, what we call a career-ending move. Today, you can go to jail. Dodd-Frank has some additional items. These are less relevant to accounting, more relevant really to corporate, to finance. Financial Stability Oversight Council and Orderly Liquidation Authority oversees financial stability of firms. The Consumer Financial Protection Bureau, this has been weakened under the subsequent administration. Is supposed to prevent predatory mortgage fraud. This was all in reaction to the 2008 mortgage problem. And the SEC Office of Credit Ratings should be ensuring agencies provide meaningful credit ratings. And we have something new. The Jobs Act of 2012 provides all sorts of incentives for creating jobs. I don't know how relevant this is to 2019. But the real thing, you want to know the provisions of Sarbanes-Oxley. They're extremely important, and they have real implications for everybody in the accounting profession today.